When someone tells you that you need millions to live off dividends, it's easy to tune out. But what if I told you there's a more economical path? A way to generate $4,800 in monthly dividend income without needing millions or waiting until you're 65. Today, I'm going to show you exactly how to build this dividend pipeline. No fluff, no generic advice you've heard 1,000 times before. We'll start by understanding how to build a rock-solid portfolio. Then, I'm going to break down 3 specific strategies that can get you $4,800 per month in a fraction of the time most people think is possible. Finally, I'll show you how much money is actually required to generate this monthly passive income. Without any further ado, let's understand how to build a rock-solid portfolio. Building a dividend portfolio isn't just about picking the highest-yielding stocks you can find. That's how most people lose money. Instead, let me show you the 4 pillars of a rock-solid dividend portfolio that actually works. Pillar number 1, stock selection, the foundation of your entire strategy. We're not just looking for any dividend-paying company. We're hunting for businesses that have consistently increased their dividends for at least the past decade. Think about companies like Johnson & Johnson or Procter & Gamble. These aren't exciting stocks, but remember what Warren Buffett says, boring is profitable. Here's what makes these companies special. They have products people buy no matter what the economy is doing. Johnson & Johnson isn't going to stop selling Band-Aids, and people aren't going to stop buying Tide from P&G just because the market is down. These companies have pricing power. They can raise prices without losing customers, which means they can keep increasing those dividend payments year after year. Pillar number 2, strategic diversification. This isn't about buying 100 different stocks. It's about smart allocation across sectors that complement each other. Let me show you what I mean. Consumer staples, your recession-proof foundation. People need to eat and clean regardless of the economy. Utilities, they act like bonds but with better yields. Everyone needs power and water. Healthcare, an aging population means growing demand, plus healthcare spending is usually non-negotiable. Technology, for growth potential alongside your dividend income. Real estate, through REITs you can tap into rental income from commercial properties without being a landlord. The beauty of this approach? When one sector dips, the others typically help maintain your dividend income. It's like having multiple streams of income within your dividend portfolio. Pillar number 3, yield optimization. Here's where most people go wrong. They chase the highest yields without understanding the risks. Instead, we're going to focus on sustainable yields. A stable 4% yield that grows over time is far better than an unstable 12% yield that gets cut when times get tough. To understand this better, watch my latest video titled Dividend Trap, 3 must-know metrics to make more money. Pillar number 4, risk management. This is your safety net, and it's absolutely crucial. A lot of investors skip this step, and that's exactly how they end up with dividend cuts that wreck their income plans. Before any stock enters your portfolio, it needs to pass these 3 critical tests. Test number 1, payout ratio. Think of this as your first line of defense. We want companies paying out less than 75% of their earnings in dividends. Why? Because companies need to keep some money to grow their business. Imagine trying to pay your rent with 90% of your paycheck. You'd have nothing left for emergencies or opportunities. Same principle applies here. Test number 2, cash flow coverage. Earnings can be manipulated, but cash flow doesn't lie. This is where Warren Buffett's wisdom really comes into play. We're looking for companies that generate significantly more cash than they need for dividend payments. The ideal scenario? A company with growing free cash flow that's at least 1.5 times their dividend payments. This gives them a comfortable buffer for tough times. Test number 3, balance sheet strength. This is your insurance policy against dividend cuts. We want companies with manageable debt levels, ideally less than 50% debt to equity, strong interest coverage ratios, meaning they can easily pay their debt obligations, growing or stable profit margins over the past 5 years. If a company fails any of these tests, it doesn't matter how attractive the yield looks. It's not worth the risk. Remember, we're building for reliable monthly income, not gambling on high yields that might disappear. Now that you understand how to build a strong foundation, let me show you the first strategy that's going to help you reach that $4,800 monthly dividend goal faster. We're starting with blue-chip dividend stocks, but not in the way most people approach them. First, let's be clear about what makes a true blue-chip dividend stock. I'm not talking about any large company that pays dividends. I'm talking about elite businesses that belong to an exclusive club called Dividend Aristocrats, companies that have increased their dividend payouts every single year for at least 25 years straight. Think about that for a second. These companies kept raising their dividends through The 2008 financial crisis, the 2020 pandemic crash, multiple recessions, periods of high inflation, market crashes and corrections. That's the kind of reliability we're looking for. But here's where most people get it wrong. They just buy these stocks and wait. We're going to be smarter about it. Here's what you need to look for. Companies increasing dividends by at least 5% annually. That's how your income grows over time. Businesses with global market dominance. Think Coca-Cola, McDonald's. Strong pricing power, ability to raise prices without losing customers. A history of share buybacks alongside dividend growth. Strategy number 2, dividend growth stocks. While blue chips give you stability, dividend growth stocks are your ticket to rapidly increasing income. These are companies in their prime, growing faster than the market average and aggressively raising their dividend payments year after year. But here's what makes them special. They're increasing their dividends by 10%, 15%, even 20% per year. Not just for 1 or 2 years, but consistently. To put that in perspective, if a company raises its dividend by 15% every year, your income doubles in just 5 years without you investing an extra penny. Instead of waiting decades for blue chip dividends to grow, you're supercharging your income growth. Here's what to look for in a dividend growth stock. High earnings growth rate, minimum 10% annually. Low payout ratio under 50%, gives room for dividend increases. Strong competitive advantage in growing markets. High return on invested capital, shows they're investing profits wisely. Think of companies like Microsoft or Nvidia. They're not traditional dividend players, but they're growing their payouts rapidly because their businesses are expanding so quickly. But here's the key, and this is where most investors miss out. You want to catch these companies early in their dividend journey, not when they're already mature. The sweet spot? Companies that have been paying dividends for 5 to 10 years and showing consistent growth. Now, let me show you the strategy that can really accelerate your path to that $4,800 monthly income. Covered call ETFs. This is where things get interesting, and frankly, it's what most dividend investors completely overlook. Think of covered call ETFs as dividend stocks on steroids. While traditional dividend stocks might pay you 3 to 4% per year, these funds can potentially pay out 8 to 12% or even more. And here's the best part. They pay monthly, not quarterly. Let me break down how these work in simple terms. These ETFs hold solid dividend-paying stocks. We're talking about the same kinds of companies we discussed earlier. But instead of just collecting dividends, they do something extra. They sell options on these stocks to generate additional income. It's like owning a house and collecting rent. That's your dividends. And renting out the garage separately. That's your option premium. Now, let's look at some real examples of covered call ETFs with attractive yields around 12%. SPY. This is one of the smartest covered call ETFs in the market. Unlike traditional covered call ETFs that sell calls on 100% of their holdings, SPY only writes calls on 50% of the portfolio. This unique approach means you're not just getting high monthly income, you're also maintaining some upside potential when markets rally. It's like getting the best of both worlds. Significant monthly income plus the potential for capital appreciation. QQQI. Similar to SPY, but focus on tech-heavy NASDAQ stocks. This ETF gives you exposure to innovative companies like Apple, Microsoft, and Nvidia, while still generating substantial monthly income. The 50% covered call strategy is particularly effective here because tech stocks often have more upside potential. This means you can tap into tech sector growth while still earning monthly dividend payments. iShares MSCI World ETF monthly income, ticker IWMI. This ETF takes the covered call strategy global. Instead of focusing just on U.S. markets, you're getting exposure to developed markets worldwide. This international diversification can be crucial for reducing risk while maintaining high monthly income. Plus, you're not limiting yourself to just U.S. companies. You're tapping into global dividend opportunities. Now, let's do some simple math to see exactly how you can reach that $4,800 monthly goal using covered call ETFs with a 12% yield compared to the traditional dividend investing method. We'll use the covered call ETF approach. First, we need to calculate the annual income needed. Monthly target, $4,800. Multiplied by 12 months equals $57,600 per year. Now, to find out how much we need to invest, we divide our annual income target by the yield percentage. $57,600 divided by 12%, 0.12, equals $480,000. That's your total investment needed with covered call ETFs. Now, let's compare this to traditional dividend investing, where you typically get around 3% yield. Same annual income needed. $57,600. Divide by 3%, 0.03, equals $1,920,000. That's a difference of $1,440,000. The covered call ETF strategy requires less than one-third of the capital needed with traditional dividend investing. Remember, though, these higher yields from covered call ETFs come with their own considerations, which is why we're incorporating them as part of our overall strategy rather than going all in. Whether you're starting with $10,000 or $100,000, these strategies can work for you. The key is to start implementing them now, even if you're starting small. If you found value in these strategies, make sure to like this video and subscribe for more dividend investing insights. I'm Andrew. I'll see you in the next one.